Howdy, Jacob here. Today we're looking at Chemed Corporation, ticker symbol CHE. What do I got here? Okay, so currently, so $8.8 billion market cap on $8.6 billion enterprise value. They're in the healthcare provider and services industry. Their margins have all gone up, revenue's gone up pretty consistently at a pretty low rate. Return on invested capital has also gone up pretty heavily. So great looking business. This growth isn't substantial, 1.4 to 2.1 over a 9-year, 10-year period, but that's pretty consistent 4 to 5% growth there. So that's pretty healthy. Earnings per share is quadrupled in that time, just about. So that's very impressive. Let's look at this balance sheet. So 74 million cash on hand and total debt of less than 100 million. Very healthy balance sheet. Cash flow. Okay, good amount of cash flow here. So it looks like cash from operations has doubled. Capital expenditures a little less than doubled. So free cash flow essentially over doubled. That's great to see. Their use of cash is pretty heavily on stock repurchases, and then their dividend of pays out 23 million, which a 5-year average of maybe 250, 300 million that's less than 10%. So a very affordable dividend right there. And looks like they've been increasing it about 6% a year for the last couple years. I think my first assumption is going to be that holds pretty consistent since it's such a small percentage of their actual free cash flow. And then as for other assumptions, I think that I wouldn't be surprised if they kept growing at 4 to 5%. I don't see the healthcare industry getting any cheaper. And it looks like they provide hospice and palliative care services to patients. Okay, yeah, I could see them growing 5% a year. And then return on invested capital is amazing, but they don't reinvest a whole lot. A lot of their money goes towards buying back shares, which is great. It can be fantastic, but it also inflates your return on invested capital as well as um, you're just not investing at those rates legitimately. And so I would say probably 17 still. I'm still feeling pretty good about them having a solid premium over market, not necessarily due to revenue increase growth, but due to the possibility of them investing at higher rates of return and then historically using money that's possibly good for a good use of cash flow, a good use of their cash flow. As for margins, they have been increasing. I'll probably sway towards the heavier end of these assumptions. Let's do 12%, 13%, and then buy back 1% of shares. So this is all assuming they buy back 1% of shares, which is maybe 80 million or so roughly. They pay out 20 million. That leaves a bit of money. Let's say they buy back 1.5% of shares. So that's 150, 170, 200. That should leave about 50 to 100 million to make acquisitions, reinvest back into yourselves, or if they want to pay down some of this debt over the 7-year period. And then we get to a final price that still needs to fall 68% for 8 to 15% return given these assumptions. It does make sense based on their current PE of 35, and we're assuming pretty similar margins, and we're basically just cutting that PE in half. I don't know if you'll ever see me make a 35 PE assumption. I think that it can be absolutely reasonable. I think if the company has 12% of growth over the next 8 years and then goes down to whatever, then your current PE can be pretty high. But you have to think about what will the terminal PE be after a 7-year period? What do I think the growth rate is at that point? What is the premium above the market again at that point? And to me, I think 17 is a good enough premium, and I think these other assumptions are appropriate. So to me, a fantastic company. I want to own it, just not the right price for me right now. Hope you enjoyed it and have a great rest of your day. Thank you.